think people are going to make individual stock decisions there. So, for instance, there may be sectors that benefit. We may be looking at the financials and energy and saying, okay, we see earnings growth there. We may be looking at some of the more software-oriented stocks which have fluttered a little bit at their elevated levels and say, well, maybe the earnings growth isn't justifying the overall stock price. My point is this, and I know it's a hackneyed phrase, Scott, but it's really relevant here. It's not a stock market. It's a market of stocks. Think about these individual decisions that are being made. They're individual decisions, but collectively what you're seeing is, on the margins, selling. Look, this is the final trading day of what's been a great year. A good decade, obviously, for the market. What's going to be the defining story for stocks, do you think? What's going to be the thing that you need to keep an eye on most, Amy, for trying to figure out what stocks are going to do in the new year?
Well, you have to keep an eye on multiples. I mean, I think that's what everybody's so focused on earnings and thinking, they're just extrapolating that earnings are going to go up and the multiple's going to stay here. I actually think if we get some momentum and the economy picks up, you're going to get a contraction in multiples, and that's going to far outweigh any benefit from earnings. So we're relatively cautious at this point. Exactly the opposite position that we were at this time last year.
Yeah, even, I mean, look, it's been a multiple expansion story for this year. Mm-hmm. There's a good debate within the market as to whether you can repeat that, whether you actually need some earnings to show up to justify where stocks are and where some people think they could go.
I think it's very hard to repeat that. We went from a tightening bias to an easing bias. We can't do that again. That's what makes your multiple.
Well, you could stay easy, though.
We can stay easy, but still you have to look at the rate of change from tightening to easing. If you stay easy, you don't get the expansion. You get the multiples to stay where you are, which is fine, but that doesn't get you another 30%.
Amy, what you're saying actually worries me because we're only predicting 7%. I know some people are up to 10% earnings growth next year. Let's say it's 7%.
We had people walking on the street this morning who said you're going to get 0.
Okay, well, I'll tell you what, but before you go there, let me just finish this thought. I mean, it's a valid point, but let's just say it's 7% and you get a multiple contraction. You're looking at an S&P 500 return next year of 3, 4, 5%. Yeah. That's where you are?
That's right. Yeah, okay. I think that's the most likely scenario, if not lower than that.
I mean, look, I raised the question yesterday of, can you think of a period where earnings are so in question? Nobody seemingly has a great thought on where earnings are going to come in, and yet we're talking about a stock market that is, basically at all-time highs, with a 26-7% year.
Scotty, if it's
Incredible.
0% next year, and we're looking at 0% this year, you don't get a flatline earnings for 3 years and maintain an 18.5 multiple. That's just not how it works. Yes, last year, we went down 20% in the month of December, which was anticipating flat earnings growth this year. That's what we got. This year, we've seen a torrid run in the S&P 500. In my opinion, there's no question that that's based on earnings growth in 2020. So we darn well better get it. 0%, head for the hills, folks.
2019 to me, it was all about technology. It was all about the performance. I cited this yesterday, 11 S&P sectors. There's only 2 sectors that outperform the S&P. It's about technology. It's about technology, and it's about the tremendous pivot from the Federal Reserve. And I think that's emblematic.
Yeah, technology is not the only thing that worked, though. Far from it.
What outperformed the S&P besides technology?
You don't necessarily have to say, well, it outperformed the S&P to have worked. I mean, the S&P in its own right was up.
Well, then I could
pretty
just buy
darn nicely.
But I could just buy an index fund then. At that point, I could buy an index fund. The financials came close.
Are you only going to buy technology stocks in 2020?
But that is the contribution to why the S&P is 30% higher.
I'm simply asking you, you're only going to buy technology stocks in 2020?
No, I'm not going to buy technology stocks only in 2020, but technology stocks are going to provide for me the roadmap as to where the overall S&P is going, as well as the Federal Reserve.
2019 was a cash flow story. Anybody who had strong cash flows did relatively well. The only way that the market looks at all relatively normally valued is on a cash flow metric. On any other metrics, the market looks extremely expensive. So you have to be with the companies that have the cash flow. And that goes back to our earlier statement. If it can't just be with services you like, it has to be with companies that are generating cash and making profits.
I'm most interested right now in the energy sector and the healthcare sector. Healthcare sector had some of the best earnings growth of 2019 and yet underperformed, up only 19% year to date versus an S&P of closer to 30%. I think a lot of that had to do with concerns about the political situation, which historically has always been a wonderful opportunity to buy pharma. Pretty much happens every 4 years or every 2 years, depending on how loud the rhetoric is politically about drug prices. The healthcare sector is about a lot more than just drug prices. And so I think there are a lot of companies in there that could work. I think the sector by and large could work.
Okay, so hang on just 1 second, because I like where you're going with this. I feel as though we have now two differing views and opinions on where your money is going to be made in 2020. Here's someone who says, you know what? It was all about technology this year, and that's where the story is going to be. It's going to remain a technology-driven market, right? Josh takes a look at the laggards and says, you know what? Maybe it's energy's time. Maybe it's healthcare's time. Maybe the best gains are the ones from the beaten down spaces that didn't perform as well this year.
So energy is up 12% on the year, and almost all of that is in the last 2 months. Last year was horrific as well. So it's not just 1 year of lagging performance for energy. It's a decade in which $10,000 invested in the XLE is now worth $10,300. You have made $0 by and large owning energy stocks for 10 years. That gets me very interested. And it's not that I'm an oil bull. It's that you still have companies that are involved in things like oil field services, drilling services, whether or not there's more drilling, less drilling, more shale, less there is money to be made in a sector that's underperformed to this extent, even if we're talking about the component that's alternative energy, which this could be the decade of battery, for all I know, battery and energy storage. So I'm looking at that sector. I bought some Schlumberger this morning, actually. First time I bought the stock, probably in 7 or 8 years. I'm getting a 5% dividend yield in Schlumberger. The whole world is aware of what their issues are, so I won't rehash all the negatives about energy services. I'll tell you this, though. The recovery in international drilling is already into its second year, has very little to do with just shale. We're talking about around the world, and maintenance revenue will always be good, even if new drilling projects aren't. So, look, I think this could be a $50 stock. I think with a 5% dividend yield over the next year, it could be a 25% total return. And the stock has done absolutely nothing for years and years and years. So I like this setup. There are some big hedge funds buying it. I'm looking in healthcare and in energy because I think that could be where the puck is going. The XLK tech sector is up 50% this year. There are no hidden gems in tech.
Right? How about that?
No.
I mean, that's a really good point.
It's a good point. You're misunderstanding. I am saying that if technology does not perform, the S&P is not going higher. That's what I'm saying. Energy has the potential.
Well, you didn't say that.
Energy has. Let me finish.
Okay.
Energy has.
Say it clearly now.
Energy. I said it before. Energy has the potential. Okay, after a lost decade in which commodities were down the entire decade, energy in the last 30 days, everyone is all excited about energy. I remember, Josh, a couple of years ago, when you get out of the XLE, you said, I'll never touch energy again, I think were the words.
I lied.
Right. So now in the last 30 days, there's tremendous excitement surrounding energy. There are a couple of names within energy that might work well, and what that will lend itself to is high-yield debt. High-yield energy debt will significantly outperform the equity if you're going to see the recovery in energy. But if you're going to see the recovery in energy, let's get natural gas prices away from $2, which they're flirting with right now because of the warm weather.
You don't need a recovery in energy. You need a recovery in sentiment. You have a stock selling at 10 or 11 times earnings with a 3 to 5% yield. I can name 12 of those right now. You don't need oil to go anywhere. You just need people to say, you know what? There are dividends here. There's not too much debt. I think the cash flows are okay. And they could take the stock up 20% with no change whatsoever to the fundamentals.
Crude's had a great year. And the stocks, by and large, haven't done anything.
I have no call. By the way, I have no call on oil. Howard Marks likes to say there is nothing intelligent to be said about the future of energy prices. I think he's right. At least I have nothing intelligent to say. So let's assume crude is just okay over the next couple of years. A sentiment shift for this segment of the market could take up the higher quality names. Would I screw around with the junk bond funded producer stocks, the small cap? I would not. So I'm looking at the bigger names, and I think ConocoPhillips is interesting. So I might be buying more of these names, at least in the first few weeks of the year.
So then is it Is it a year where you look for opportunities in things that underperformed, or is it going to be a year where you just keep riding the momentum of where the big money has by and large been going?
I'm very
this is
well
the
aligned
conversation
with,
that
I'm very
we're
well
having
aligned
here.
with Josh. Healthcare is my largest overweight. Not only has the sector been completely decimated this year and underperformed, but there's been amazing breakthroughs and productivity improvements in healthcare that have gotten absolutely no press or no reporting. I mean, we've had our first CRISPR trials. We're curing diseases that were incurable for decades, and so there have been a huge amount of breakthroughs, and we really like the healthcare sector. We've also closed our energy underweight recently, added to Schlumberger. I think you just need a weaker dollar and a little bit of inflation. I think what these two guys are talking about really
kind of what you're sniffing right now, right?
Really, exactly.
Weaker dollar and a little bit of inflation.
You're going to get an energy to re-rate. And that's also the difference between an energy call and a tech call, whether you're in an inflation or deflationary environment.
Jimmy?
So I just want to go back a month ago. I was on with you and Jimmy Cramer, and I said that energy, this was a month ago, energy is going to do what financials did 6 years ago, 6 months ago, had been totally left for dead. Everybody hated it, and now was its time. The reason for that, just to back up what everybody's saying, is that capital allocation has been rationalized in the energy patch. 5 years ago, you had the start of the decline in energy prices and a whole wave of bankruptcies in private, small companies in the U.S. That totally crushed sentiment, which has now been cleared up. But I don't think it's just energy. I don't think it's healthcare, just healthcare as well. I think financials continue. Look, it seems clear that the global slowdown in trade that happened in 2019 is over. It's starting to pick up again. With that, you should see yields higher. And the surge in money center banks should continue with slightly higher, slightly steeper yield curves. It doesn't take much for that to continue. So add financials to the list.
But to Joe's point, and to square the circle, that might mean it's not a great market overall. If you do get the big cap stocks.
Oh, well, you're not going to, of course. Yeah. I mean, that goes without saying.
Right,
you're more than likely not going to have a great year in the market if the biggest sector within the market doesn't have a good year.
Unless it changes.
Right. Unless you have a massive rotation.
Unless you have a massive rotation.
But there's a natural buoyancy to tech. And Josh, I'm stealing your thunder on this, but I believe it, and it's just factual, that all the ETFs are so heavily weighted in Apple, in Microsoft, in Amazon, et cetera, in Alphabet, that just the passive investing and people putting their money back into the markets, and we know that for the last few years there's been outflows. As money flows back into the markets, those passive ETFs are going to have to buy those technology stocks.
Apple and Microsoft accounted for 15% of the gains for the S&P.
And at least a good portion of that is ETF buying.
Yeah.
It just
you
as
could,
money
so let me just, this is really important. You could have money coming back into stock mutual funds or stock ETFs. Money has never stopped coming into stock ETFs, but stock mutual funds, active management. You could have that and not preserve the same top 10. And the best evidence of that is GE was once in the top 10 of stocks. It's lost like $180 billion in market cap. So flows coming back in didn't just prop it up because it was in the top 10 of ETF holdings. So you could have that rotation where money does come back and chase the market into stocks, but you end up with a different top 10 at the end of the year. And I think that's like an important distinction.